Thanks for tuning in and welcome to our mid-quarter market commentary review. I'm Bob Baker, President of Advanced Asset Management Advisors, and joining me today is Phil Volker, AAMA's Chief Investment Officer. Hey, Phil.
Hey, Bob.
How's it going?
Good.
Good. Let's jump right into things and talk about inflation. We got some new inflation numbers in the last week, and some of these are a little concerning. You want to update us?
Sure. As everybody knows, we've been following inflation carefully over the last several years and, warning about it early. And while rates have come down, inflation rates have come down, it's not been an easy road. And in particular, in the last 6 months, if you look at the headline CPI, it's gone from actually a small negative to an annualized monthly rate last month of 5.6%. So, the trend is not real good on a short-term basis. Even the Supercore PCE, which is the Fed's favorite measure, it's gone from 1.9 to 3.8. So, the trend is not good. There can be some seasonality in these numbers. It's not been wrung out of them, but clearly the Fed is justified in standing pat with their interest rate policy at this point in time.
Yeah, it's kind of a side note. Walmart came out with some kind of concerning future guidance in terms of what they see within the consumer. Did you read that too, or want to update us on that?
Yeah, I think it's indicative of the general trend, in particular lower income segments of the economy, which of course Walmart caters to. Looking at sales volumes and sales trends, a lot of people across the income spectrum are going down value and not buying as many headline or name brands, but buying more generics. And of course, sales prices are lower and profit margins are lower on those, which Walmart is warning about.
Just some interesting comments out there. Let's move on to stock valuations and earnings. Can you kind of review the landscape and earnings and valuations today?
Sure. The stock market, everybody focuses on the S&P 500, but stock market measured with the S&P is still overvalued on our valuation process. The index level forward PE at 22 times, the median is 16. So it's definitely overvalued. Even if you take out the big tech companies, it's still at 19 plus and 19 and a half with a median of 15. And those median numbers are over the last 22 years. You can go back even further as far as you want, really, and find that we're definitely overvalued. Small caps, mid caps, NASDAQ 100 at 28 times forward with a median of 20. So no matter which index you look at, large, small, growth, it's still overvalued. And earnings numbers had been pretty optimistic for 2025. They're still reasonably positive, but the level of the 25 estimates has been dropping. It always drops through the course of the year, but this year it's been dropping a little bit faster than it has been in prior years. So, and a good part of that is the technology sector is influencing the decline in the earnings projections, being a big part of the earnings growth, just like a big part of the index price. The large cap tech is heavily influencing the not just price valuation, but earnings trends as well.
Sure. What's the current forecasted increase in earnings for 25?
It's running around 13, 14% right now. It had been 15, 16.
Right. Okay. Now, we many times get the question from advisors, are we in a new normal or a new norm in terms of PEs and earnings? Um, uh, how would you address that comment?
Well, before anybody can answer that question, you have to understand what somebody's quote normal perspective is. And it could be the last 15 years since the great financial crisis, which had been dominated by low interest rates. You could look at the last 3 years, which has been a period of rising interest rates, or you can look at 100 plus years of long-term market valuations. So, if you look at the last 15 years, yeah, we're in a new normal of higher interest rates. If you take the last 15 years and compare it to the last 100 years, we're in a new normal of lower interest rates. So and I'm not trying to be flip about it, but the new normal has to be defined relative to what your normal is and the time period that it covers. We look back in our numbers approximately 1990, so 35 years. And we also pay attention to some of the real long-term work. But from a valuation standpoint, these kind of levels are high, no matter what period you compare it to. So I would say, no, it's not a new normal. It's a period of time that's categorized as highly valued markets. And we've seen them before. We've seen them in 07, 08. We saw it in 2000. We've seen it in the 60s, early 70s. So it all depends on your perspective and your time frame.
Absolutely. Let's move on to talk about some real current stuff like tariffs, trade deals, government audits. I was hoping they'd have a sign-up list so we could go do the Fort Knox gold audit, because I think that would be fascinating to crawl around in the vault and see what's there, or maybe what's not there. But anyways, if I get a chance, I'll sign you up for it too.
Yeah, that would be fun. At least maybe we'll get to see some videos. And knowing Trump, he would definitely want to have a video of him standing there next to a pallet of gold bars, right?
Or are they going to test every gold bar in that vault? I mean, that's the next question.
Yeah, I don't think so.
Yeah. So let's shift back to tariffs. What's your perspective on that?
Well, before we talk about tariffs, there's really three things dominating the news right now. One is, as anticipated, regulations and cuts in regulations. And some estimates put the cost of regulations at close to $3 trillion a year, which equates to $10,000, $12,000 per employee. So cutting regulations and the cost to comply with regulations on the margin will be an improvement in corporate profit margins. They're not going to go away 100%, but it's a positive in general. And obviously some sectors may be more positively affected than others, be it energy, be it banking, whatever. So, that's a marginally and gradual positive trend. Probably one of the biggest headlines is, at least outside of the financial news, is the Department of Government Efficiency and all the hysterics about spending cuts, et cetera. With the size of the federal government and the amount of entitlements included therein, it's hard to see a huge impact from spending cuts from this effort. But long term, there could be some marginal improvement in debt and deficits. Short term, it could be a headwind for growth as you start cutting funding of certain things. But long term, it could be a nice little marginal improvement in the deficit and debt, which sort of segues into the tariff thing. And of course, tariffs have been a subject of a lot of commentary, especially in the financial media. And the comments are generally negative because of two concerns. One is a trade war, which was one of the factors that contributed to the Great Depression in the 30s. And the other is inflation and how it could impact prices if importers have to pay more. But if we take sort of a long-term look, the tariffs is what funded our government for a long time in the first 100 years or so of our existence, probably 150 years. And our tariff level right now is considerably lower than it used to be. And compared to the rest of the world, we're on average about a 3% tariff rate right now. The European Union is about 5%, and China's about 10%. So we're considerably lower than the rest of the world. So us raising tariffs to some degree probably wouldn't touch off a trade war. At least other countries that have higher levels would have trouble justifying it. Specifics like automobiles from the EU, we tariff at 2.5% right now, and they tariff our autos at 10%. So a lot of this is a result of the level of generosity we as a country felt after World War II, letting countries sort of take advantage, if you will, of our buying power, our markets. But back to reality, in recent history, 2018 and 2019 tariffs really did not impact inflation because a lot of that was offset by currency changes, a devaluation of other currencies. So there's a lot of moving pieces. Currency changes can help or hurt the impact of tariffs. And we have to keep in mind, too, that the United States is in a unique position, and that is that, we export a lot of capital in the form of reserve assets, which the world needs to conduct trade. So, there's a relationship between how much we can import versus how much we export in the terms of financial reserves. And it's been referred to as a Triffin dilemma, where those two can stay in balance for a long time, as long as the reserve currency, which is in this case the dollar, continues to hold its own in world trade, and we don't get into a weakened financial position, which questions the fundamental valuation of those reserve assets. So again, there is a large number of factors that come into play. They all interact with each other. Headlines have been driving the reaction in the markets. We don't know what's going to be implemented or when, or most importantly, what's going to be negotiated. And really, I think the objective that everybody has to keep in mind, and hopefully the administration does too, is that our objective is to reshore manufacturing that is high value added manufacturing. So, not bringing back textiles, but bringing back computer manufacturing, consumer electronics, automobiles, etc. The high value add stuff is where we would do the most good. That's sort of a long-winded answer. Sorry.
That's okay. That's a good answer, and I think it addresses a lot of questions our listeners might have. So that kind of sums up our topics for today. I'd like to thank everyone for listening. If you have additional comments, questions, or concerns, Phil and I and Aaron Plaskow of our firm are always available for conversations, email chains back and forth. Please give us a call. We'll be happy to spend some time on the phone with you. Thanks a lot. Thanks, Phil.
You're welcome. Thank you.